If you love our crypto content or are looking to learn even more about crypto, be sure to check out and subscribe to our new YouTube channel after this video dedicated to all things crypto. Find new videos every week. Be sure to check the link in the description.
Chris, great to get you back on Real Vision. It's been a while. I don't think you and I have actually sat down and talked on Real Vision before.
No, sir, but thank you for having me.
Listen, we've got to know each other over recent times, and I'm just finding it fascinating where this whole kind of asset management industry is starting to go, right? So just for people who haven't seen you before, talk about a little bit about your background and what you guys are doing, and then we'll just dig in a bit.
Sure. My background's more on the TA and trader side, started in '06 at Morgan Stanley, and then broke out after the financial crisis to form our own fund in 2010. And we ran a vol arb fund all the way up until switching over full bore crypto in 2018. But my side is mainly on the systematic allocations. I had to teach myself code and design various trend following.
How'd you teach an old dog like you code?
Well, I'm not yet 40, but it's actually, that's a really good point you bring up, because I think my team's super unique, and it includes rock stars like Haim Bodak, Rishi Narang, Kamal Mokadem. I'm the humble servant of the big guys. But I think our guys, we blend, we're just old enough to have gone through that transition from ticket writing, which I even did back in my day. And you were at Goldman, when Haim was there, transitioning to the electronic and then the high frequency and all that arms race. I think our generation, call it 35 to 50, right, has a unique experience in the space, in asset management in general and in trading in general, that likely will never be matched before in time, right? None of the kids younger than me will ever know what it's like to open outcry, right, on S&P futures, or be at an actual trade desk. Like Morgan had a giant desk in White Plains, right? And UBS had a giant desk in Stanford, and you know what I'm speaking of. But now you have, very few equity traders on desks or bond traders on desks, and it's just an experience where I think the value add of the real-time risk management and desk trading on top of the tech end, whether it be CS or algorithmic or machine learning, that hybrid experience that we've had, I think, is really why we have a nice balanced offering here that we first built for ourselves, but now is scalable and repeatable, I would say. So
why move from vol arb into crypto? They sound like different things.
Well, not yes and no. It's a loaded question. In VIX trading during this last decade, that's, if you want to be long vol, you're basically teeing up money to get smashed. We luckily ended up positive more than negative, but it just was kind of a losing effort out the gate to be hedging constantly for the types of portfolios we were hedging, and people allocate to vol funds not to have that negative convexity, but they want the positive convexity. And just doing that from 2010, really between then and 2017 was really difficult. You had the VIX drop all the way under 10. So that vol trading, though, really gets us excited about crypto, because with what was a 90 vol, now it's a 55 vol on BTC. That's very exciting. A lot of alpha there, a lot of risk management techniques you can use to extract, whatever thesis you have.
So when did you start the business or the fund? When did you start this whole thing, and how did you go about kind of constructing it? Because you were relatively early, and there was no tools in place to do any of this. So talk me through that whole thing. When did you start?
So we, Haim and myself and our team, we first were doing, we were doing the basis arb.
Hi, I'm Raoul Pal. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to reversion.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to reversion.com, it costs you $1. I don't think you can afford to be without it.
Do any of this. So talk me through that whole thing. When did you start?
So we, Haim and myself and our team, we first were doing, we were doing the basis arbs, ETN over futures within the vol arb structure, doing some create redeem stuff in ETFs. So just some basic stuff that had made us a little bit of money. We had invested in a Bitcoin ATM company early on as kind of the first PE type VC investor.
Which year was this we're talking?
This is early 2017, kind of before it exploded. We started looking for a manager or managers right in the Q2 of 2017. Going, all right, we can see on the chart. We don't know much about it. Read the white paper, got passionately involved in the theoretical and the esoteric, psychological benefits of, I can be my own bank and the distributed ledger technology. But we knew what we weren't good at, which was crypto analytics. And we hunted a few managers and did our due diligence. We're just like, you know what? No one we're talking to is doing it the way that we would do it. So, but mid 2017, we started designing software to trade it, creating our own order book. We aggregated at that time 6 exchanges, 5 coins, and created basically our own NBBO. And we would do
NBBO?
National Bets Bid and Offer, old school term.
Ah.
Yeah. Because, we wanted to have a midpoint price, right? Because at that time you had very real tech access difficulties because you had REST APIs. Those were unstable. And really it was a cluster F to put together. Very manual. Even the signals were gray box. We had models on Bloomberg Terminal. We had a very robust kind of viewpoint that Heim built with aggregating all the pipes. And then we had buttons to press, very video game-esque, green for go, red for sell. But once we figured that we had the tools to actually trade effectively-ish, then we spun up the fund in 2018. We funded it large scale, our money. We're still 40% of our AUM today.
So you set up a crypto fund that's trading on algo models in 2018, and the market's now plummets like a stone. How do you get on?
Well, thank God we, as Heim put it, we had ARB you could drive a bus through. So we did that mean reversion trading, and that gave us a hell of a P&L for 2018. And very, very honestly, we would make 300 bips in a day and call it a day. Because you could basically just go back and forth between the major venues at the time, Binance, Bitfinex, Bitstamp, et cetera, and just know when to transact.
Did you take any directional risk at that point?
Yeah, I would say roughly 25% was just buying the traditional oversold signals on a daily basis and then selling the overbought, just old school mean reversion. And we just combined that with the arbitrage.
And that worked in the crypto winter?
It did.
Fascinating.
We had a lot of fun. And where it wasn't very fun was when it compressed into that triangle before dumping into December 18.
Yeah, that was a scary time.
Yeah, and it was difficult because the ranges had a lot of false breakouts.
This was, I think, was the tether break point.
Correct.
That was when Bitfinex had not funded themselves. That was what was going on there, and then the break.
Yep. And so that was like, all right, we're not getting caught just being a one-trick pony. That was really impetus. All right, we've got a little bit of attention to pad some investors in for Q1 2019. Let's diversify this into what we want it to be. At that time, we didn't have any, exchange fees that were discounted for hedge funds. It was huge for what we're paying. So we got into doing market making and sort of tagged on additional strategies that were value add to the portfolio itself that we knew we wanted to get to because we've seen this before, as you have, going, whether following Rentec or Citadel or Two Sigma, those guys have really laid out how you do it properly. And that takes us all the way to here, where we have 11 systematic strategies going. We're staking, running masternodes, and really have kind of an all-weather.
And that's all in one fund, or does it separate into different strategies, or it's just one?
It is just one fund. We're very
11 different strategies going in one fund.
That's just on the algo side. There's more strategies than 11, but we need to solve for intraday vol, and then need to have 2 week to 4 week time horizons on the longer duration stuff.
So then what does that do to the volatility of the fund itself? Have you dampened volatility but kept return? How has it kind of worked by adding all of this?
Of course, as soon as you get fancier, you give up some of the beta, right? So I think the way we look at it is obviously through Sharp. We also want to calculate the daily against MVAR, like what's our actual modified value at risk? Because if that is decaying or the attributes of the risk reward profile isn't what we're looking for, then we gotta retool it. So here, here we're really looking to play offense and defense simultaneously. And we've had a few periods, even the most recent month to date, where there's outperformance more often on the down than the up. Because nothing we've designed really can grab, anything these, DeFi or NFTs are doing. So
are you finding that you're smoothing the downside volatility or generally profiting from it, whatever, probabilistically, more than 50% of the time? It seems to be working, that the downside's pretty good and you capture a decent slug of the upside. So you're slightly smoothing the volatility, but creating a better Sharpe.
Yes, better Sharpe, lower beta exposure to Bitcoin itself and the indexes themselves. And so what it gives us, since we designed this for my partners, I primarily, is the experience that we're looking for as long-term investors. What do you want to do? You want to compound, you want to take advantage on drawdowns in any kind of systematic fund. And then what do we want to do? Capture the upside as responsibly as possible.
And what kind of peak to trough drawdown will you stomach? Because the space has a lot of drawdown. It's a very volatile space. So, you've come out of the traditional world of which you would have never had to deal with A, the returns, B, the volatility, and all these things. Right. How do you think about peak to trough drawdown? Or are you just trying to ignore it? I mean, how do you deal with it?
No, I mean, not ignoring it. We had a really nice event to highlight the differentials last March, right? Like that was brutal to see it go down 59. I think we were down about 22 or 21 and a quarter. So that was where real-time stress test. And at that point, maybe the hedges that we have in place now, or the magnitude of them, were not in place to the degree that they are now. So that event would only cause, I hesitate to speculate, but call it 12 to 15%.
How did it compare versus what your VAR said it should do? Because there's reality and there's the model. How did you do it? Because it sounds like you didn't do that badly. Down 22 is not bad considering you're always invested.
Yeah, I would say it was 200-300 bips worse than we had expected.
Right. Okay. That's not.
Yeah.
I mean, that's not bad. So you talk about hedging. How the fuck do you hedge anything in this market as well? That's the other thing. People go to me and like, do I need to open a Deribit account? How the hell do I do that? What does this mean? How do these, futures contracts, they're all trading crazy rich. I mean, how do you do it?
It's not easy. And that's why, we spend 99% of our time running it and kind of reanalyzing constantly. And that's why even the acumen level that my team has, which doesn't get much higher, it is very, very challenging and exciting. And that's why we're very passionate about it. But it starts really at when you're doing systematic, right? Because we come from the long short side. Automatically, when we're designing a model and stress testing it or running it through Keiko data or Bloomberg, whatever system we're using to stress test and back test, the setting for short becomes cash, right? With the products, ETH futures, BTC futures, obviously that's the lion's share of it. We also do options in the OTC space with our market maker friends that we have a lot more confidence in than some of the DEX.
And what are you doing in the option space? You're just buying premium, or you're market making premium?
Well, we do both. We do market making on the premium on exchanges. On the OTC side, we're selling collars, old school.
Right.
So our fund takes a position of off exchange assets and custodians. So it's a mixture of staking and net long. On that net long, we want it to perform and be hedged. Selling 30 vol collars and rolling them is just a simple way to do that. And then we take the proceeds, reinvest, and double compound. Similar to staking, except the annualized yield for selling collars is quite a bit higher. It is based on the basis on futures, and then the reinvesting adds another couple hundred basis points to it.
And then how are you dealing with the custody and PB and leverage and all of that stuff?
Our fund does no leverage. We ascribe to Mr. Munger and Mr. Buffett, ladies liquor leverage. We're all married, so that limits the ladies. None of us are alcoholics, so that's good. And then we don't use leverage.
I'm surprised you're not alcoholics trading crypto.
Like you can't be 24/7.
True.
So if you are, you'd fail, and we'd be out of business, and you and I wouldn't be talking. So the fund doesn't use leverage, nor does it intend to. And I think looking at this more top down, I would argue whether it's CME or more traditional platforms coming out with more options, I do think that the effectiveness for larger capital to come to work that would be sort of door opened again if the hedging elements can be increased. But the problem with that is, okay, you issue all these option contracts, that doesn't mean liquidity is going to come.
No, although the OTC market, I know Galaxy are ramping up. I was speaking to those guys in Asia that I interviewed on Real Vision. There's a whole bunch of people starting to make pretty active, decent markets, and they look like they're pretty deep in Asia, more so than here. And there seems to be vol sellers in Asia that gives a nice two-way market.
Right, and we're vol buyers. So it is right now, and between Galaxy, for example, we can have as a QIB, we have ISDAs with them, again, old school style. We've got shared wallets with the custodians, to go back to your question. And we actually have been doing this long enough to where we tune the strategy to the custodian. A lot of our staking is done at one custodian that's really, really good at it. One of them is just running masternodes. They're very, very good at that. And then a couple of the US custodians, they're good at holding the shared wallets with our market maker friends that we trade options with. So we basically tuned the strategy to the counterparty.
And how do you, so a million questions, and how do you allocate, because I just think it's fascinating, how do you allocate amongst the various strategies? What makes you decide you should have a strategy? What makes you decide how much capital or risk capital to put into a particular strategy at any particular point?
It starts first, well, I can get into like a strategy genesis and walk you through that process, but
love to, yeah.
But I guess I could frame it first. Top-down allocation every month. We're rebalancing at our investment committee meeting, right? How does that look? It's all right, based on the strategy matrix, what was the correlation between the strategies? What was it to the index? What were we expecting? And then how did it do? So with that, we sort of rebalance on this weighting ought to be higher, this weighting ought to be lower, but only within a few hundred basis points, because we might try and anticipate this strategy should do well in this environment. And then of course you're always wrong. So that's the point of having all the strategies. What's kind of sexy about what we've built is that it compounds intra-period, which works against you, obviously, if you're losing. But we basically have each container completely siloed from one another, so we can really see what the risk reward is of the strategy real time. What are the daily returns? What's the attribution of the risk reward? And how does it look from a
so you kind of separate them at P&L level so you don't pollute your P&L and your risks.
Right. And we found that some of the hybrid strategies, because you've got these broad categories like trend following, what does that even mean other than buy when it goes up, sell when it goes up? We've got some hybrid systems that seem to work since they're reactive algos. We don't have data going back, decades, right? So using some more tricks of the trade from a trader's perspective and some pairing of reactive algos give us a little more edge than the more traditional how you run market neutral or stat arb or long short. We still have on the stat arb, long short, and market neutral side, that's predictive, but the reactive side has a lot less risk to it, tighter risk controls, et cetera. And
when you say you run these strategies, is this just different algos that you've developed, or is it different teams you've got developing different? I mean, how the hell do you develop all these algos and the skill sets that all these different things?
Because our team has one aspect of our team is good at the stat arb market neutral side. One aspect is good at HFT market making. And
so stat arb, sorry, again, a million questions. Stat arb and market neutral is like it might be, one oil company against another, and there's a relative relationship on an intraday basis. You're doing it amongst coins.
Correct. And what this team is really excited about, and I'll give you a little lift up the skirt, on our last investment committee meeting last week, we're getting into a deeper modality of cross currency. Because what I'm personally getting sick of, and I know it's mine and others benchmark, I don't want to trade this in fiat for much longer. I just don't. That's not why we got into this. My tolerance for doing that is waning. So we are rigorously testing both in BTC, ETH, especially layer 2 against ETH, that has its own sex appeal. And then some of the native tokens that we've rigorously tested against Binance, like BNB, that's an incredible type of market in of itself. What's not there for me to do that at an institutional level is the depth of liquidity right now. But we are preparing for that moment.
And how do you decide what tokens you're trading? It's fine, all well and good, Bitcoin, a bit of ETH, but then there's this huge world of stuff that's correlated. Some you don't really care because a lot of the time horizons are short stuff. So, you're not buying into the concept behind it, you're trading it.
Right.
But when does something become tradable for you that you think it's worth doing the work on to get it into the model and set up the execution, the PB, and all the other shit that you need to do?
And that stuff's like, it takes months to do that per coin, to be very honest, because we've got your traditional auditor and admin, and they've got to approve and sign off and everything, and that's as bureaucratic as any other process. But I think from our perspective, because a few of our team members are OGs, as you would say, we have a little bit of a code purist and a chain purist bias. So I would say if something's going to be qualifying for all of our systems plus a net long exposure, like a bid or an ETH, then we have to really stick to the quantitative being the lion's share of how we would rate and rank them. But we do very much employ the qualitative. We're vetting team, we're vetting code, we're reading the code audits. All of that stuff is very important for, especially on the DeFi side, what constituent might be added. But there's a threshold, no token we would add beyond the top 50. We're right now at 28. Our portfolio is constrained to 30. We're kind of old school in terms of we concentrate.
And my guess is that nobody is yet, or not, nobody is probably the wrong word because everybody's doing something in this space, but not many people are looking at the early stage stuff and trying to build models around, whether it's network adoption or whatever it is that gives you the 100x at this point in the cycle. There's got to be signals that come that you're probably able to figure out.
Yes, and it's both qualitative and quantitative. We're exposed to a lot of pre-use case projects and also consulted to underwrite them for others. We are underwriting them for ourselves. Whether or not we spin something up within the structure is to be continued. Wink, wink. But I think we've got enough of hybridization on the systems to where we can get ahead of this for a small portion of the portfolio, where the asymmetry of that risk reward is just too huge to ignore. We're going to get the signal real time, and the stuff's going to be 79 to 91% accurate on that signal. So it is.
And that's a longer term time horizon, or is that shorter?
Yeah, that's where it's like, all right, this is going to eventually get to where we need to be that long. We need to have something custom. And where do we identify those opportunities before they occur?
Yeah, that sounds like that's a separate side vehicle as well, right? Because a lot of people would be interested in that kind of specific exposure at the right point in the cycle.
Touche. However, we are very afraid and cognizant of being a master of none, and do not intend to offer any other product than this.
So you just put it all as part of the master fund and let it generate its form of alpha within it.
Because the diversity of strategy, to have things winning when others are losing and others losing when things winning.
So, it's the millennial. It's the Millennium approach and others.
It is.
So Millennium is call it a 5-vol fund that generates 8% of return.
Mm-hmm.
What kind of average vol do you think you have and your average return over the cycle? No, not over the cycle, per year.
It varies, but I would say we're not too much higher vol than that. Maybe a 25, 30 vol intra-period with a 60, mid-60s return annualized.
So 25, 30 vol with a mid-60s average return from that volatility.
Yeah.
So, that's still a significantly different Sharpe ratio than the industry. And that's what I want to get onto is how correlated is that to Bitcoin itself?
But we're only running at 0.4, 0.46 correlated. We are correlated to vol.
You're correlated to vol, okay.
Right, and where it becomes negative on our
So when vol rises, you make high returns generally?
Yes. And then
because it's skewed. Oh, well, you don't really care, actually.
The space between those, right? Because then it would compound faster. And the space better than most. When does vol rise? You need to go in both directions, but usually on the way up. And here we've had vol compressed to multi-month lows, but we've had enough on the intraday spreads to make our fund money and compound that. So that's why having a multi-strat is great. Our HFT strat is up 11 last month. I would not have thought that. We designed it to be up only a couple hundred basis points. But as long as there is both the day vol and then the spread, we have the ability to make money.
There's a lot of complexity to what you have to build.
Yes.
And it's a different cost structure as I can figure out because it's so early. So the fees that you pay, the custody services, all of this stuff, are the fees still the same in this industry as it is in the traditional hedge fund industry where they've been getting crushed? Then they've got to be higher, right?
Yeah, you're talking about the funds fees or the fees we pay to operate it?
The funds fees, what you charge.
Yeah, we're 2 and 30 on the basic share structure. Most of the stat arbs and millenniums, et cetera, and those comps are 3 and 35. We kind of went under that. I think from our perspective, if you were to comp, it should be 5 and 50, to be honest. You just can't stomach that. The operating expense is almost quadruple of the funds we ran before, and that was still.
Yeah, that's what I was thinking. And the operating expense has got to be super high for this.
Yeah, and that's before we don't really even pay ourselves. We reinvest in the fund. So, investors discover that real quickly when they do due diligence. Like, holy shit, you guys are not paying much in trading fees because you've been around a long time. But yeah, having multiple 16 core servers cost money. Having all the differentiated custodians, having 12 trading venues. All of that, it has an expense to it on top of the usual stuff that funds have. We're not isolated to, Goldman Sachs is our single prime.
And what do you think the magnitude of alpha is in the space in your group? Well, you've got a big look at a load of strategies, right? So you get an idea of overall alpha. What kind of alpha do you think is in that space versus the alpha available to Millennium, who's running in traditional markets?
I think it's more than double.
I would say that way more than double.
Yeah, I'm being conservative. I mean,
I'm not asking you to forecast your own returns or anything,
yeah.
But I get a sense that the alpha here is full cycle alpha over the whole thing is, this is not, it's not 10% or 20%, it can be 50 or 100%.
Oh yeah.
Of the, of the overall asset returns over time.
Mm-hmm.
It
also depends on what you're calling full cycle, right? Because I would argue we've only completed 1 and then 2 full cycles in crypto. So we really only have that concise period to look at. So this one we don't really know yet.
We don't know. We don't know. All I know is the returns from the hedge fund space, from the pure crypto hedge funds, have been, eye-wateringly large. It's been extraordinary and that's from different strategies. You've seen it across your strategies. How many strategies have been making money in this? And it's not just a function of beta, because you've seen choppy markets. You guys are short term, and yet in those choppy markets, you generate returns. And the same is true elsewhere. Who else do you see? What developments do you see in the crypto hedge fund industry that you're thinking, oh, that's fascinating? What are you seeing going on elsewhere?
I think what I really like is the maturation of a lot of the beta and index products. I think the accessibility as well as the volume going into them shows the spaces, at least in, call it inning 3 or 4. And then what comes next is funds like ours or ARCAs or any of those highly active, highly disciplined fund structures that are in the space and diversified. I think that shows us that next move is coming. I think the makers and prop firms are doing stuff in DeFi that's fairly extraordinary. Most investors don't have access to that, as you know. But we're not really cognizant of what others are doing because this is a 20-hour day gig.
I haven't seen that many people doing what you do, which is a multi-strat, very broad, very deep crypto fund.
Mm-hmm.
But what's been interesting is when I speak to all of the participants in the space, ARCA, they do a very different thing. They're kind of bottoms-up token investing. And Raoul Pal is kind of more asset allocation-y, right? Everybody's doing different stuff. Money's really slow to flow into this space still. And it blows my mind. It's like, this is the biggest alpha the financial markets have generated in a long time. Maybe since, for a long time.
And that segment should be going to us and others that you just mentioned for the risk management, right? Like, okay, we get you might be scared of a pure beta. index fund that already has the AUM you're looking to align yourself with. But if you want these robust hedging products and option products to become real, the active funds that are in the space need to be gigantic to support the two-way trading of that.
Yeah.
Very realistically. So you're right to say they're a little late to the party.
Yeah, I mean, yes, look, we understand. Everybody's trying to get Bitcoin on the books first,
right?
Let alone this. But I found that the family office space has been slow to the crypto hedge fund space. I found that banks, fund of funds, other allocators been relatively small allocations still to what seems to be, the last time I saw anything close to this was when high frequency trading really got going. I mean, there was some egregious returns that came out of that for a while.
Yep.
Then there was macro in the kind of 80s and 90s, we had gigantic returns. But even then, that was like 15 vol and 30% returns.
Right.
Nothing like this. Only high frequency trading was the only thing, but it was an arms race and it went. Right. What's interesting about this space is there's more tokens, more complexity every day. So it's impossible to arb it all away. The alpha, I don't think the alpha is going to go for a decade or 2 decades.
Nope. And where we would potentially get a little more risk taking between these jurisdictional venues, right? If we assume the US does some competent regulatory action that would allow us to take a view, okay, here's the box we can play in, we can go further deep into these jurisdictions. There's not going to be an NBBO for perps on whatever platform. There's not, right? And the convexities here in US might be concave and then convex in those other venues, but we're not going to take our money and investor money and silo it in a way that's not as secure as the current way we're doing it to arb that away. But in the event that we've got some clarity, of course that's there. And at times it might be because these option or perpetual expiration cycle might be 8 hours. You have different funding rates. So people need to understand what drives the pricing of these products. We take more of a purist view where there's only going to be so much financialization product that this fund takes. We want to be in the underlying. However, for hedging and for alpha, those instruments there you can get both out of it. And the basis arb is gigantic. We're naturally long and short at the same time. So we're always monetizing that.
How are you going to deal with, right now it might not fit into the fund, but as you grow over time, you'll find more esoteric buckets. And we're going to have the tokenization of everything. And there's got to be a liquid market between whether it's NFTs or whether it's real estate NFTs. I mean, all of this has to have markets around it. Sure, some stuff will trade by appointment, some stuff will never trade at all. But other stuff's going to get relatively liquid. I'm looking at those NBA NFTs, right? That's probably going to be a liquid market. How the hell do you figure out what are the smart contract terms? What can you do? I mean, you will end up just having a team trying to figure out all of this stuff, the complexity, because they all kind of look like derivatives, right? You and I have come from derivative backgrounds.
I have a smart contract formula breakdown research that we just wrote internally to try and deal with exactly that I was reading before we jumped on. I think the simplest is actually the quantitative, like bring it up, make me have to trade it. But we are biased and purists. So I think the way we look at it as we start with layer 1 protocols, then native layer 2, and then beyond that, what's really sector specific, whether it's a yielding token that we can stake, or it's a specific DeFi project that's nascent, or one that's not out yet, like Definity, that could do all kinds of fun things, or whether it's Web 3.0, all of the above. You've got differentiated sectors, but for how we analyze it, there's a way to siphon it upwards, right? And just first look at the liquidity side and rank it quantitatively, and then rank it qualitatively.
And how do you know what the esoteric risk is, right? Financial markets, we kind of know what the second order risks are. Yeah, your prime broking gets pulled. Yeah, all sorts of stuff happens that we kind of know about. And I was talking to Mike Vranos from Ellington, right? Structured finance, $10 billion hedge fund. And he
Yep.
talks about the second order risks that a lot of people don't realize until they blow up once. And he learns it. How the hell do you figure it out with what you're staking, the DeFi protocol, how? Or is that just position sizing?
That's one way of doing it, but that's before we even get there. We oftentimes test with our money in our GP that there almost never has been a circumstance, whether it be staking or strategy or algo or whatever, that we don't test it for months before it goes into the fund. So that's just our process of how we do it responsibly. But to get into second order risks, hyper diversification of counterparty is one way that we do it. The fund is not exposed to more than 15% of any given counterparty. Doesn't matter what strategy is running there. That's one way of looking at it. There's not a weighting, a bit at sometimes it's 35% of the fund, but that's kind of its top end. And we can hedge a lot of that out, to be very honest. But we analyze smart contract risk. And within that, what subsectors do you have of smart contract risk, right? Because this is a trustless, permissionless system, but it's not one without risk. So you have to look at all the code audits. You've got to look at, is there a public GitHub bug fix to any of these DeFi protocols where you can look at what crazy, people have put on there and said, no, you got to do it this way. And that's one thing I really love about the crypto space is everybody's hardcore advocate and defend. So if there is something wrong and the people operating the token are transparent, someone's going to get in there and fix it, or at least expose it. So that's been really helpful for us over the last 2 years to differentiate. All right, how are we weighting, for example, Aave, Comp, and Wi-Fi and Uniswap? How are we weighting our allocation of that? Well, these qualitative terms are how we're doing that and how we're measuring the smart contract risk. And then looking at the liquidity pools, right? Some of this stuff is silly. As silly as some of the NFTs where you've got these APYs in the hundreds. The cool thing is it's hyper capitalist, demand money coming in, interest rate goes up. Supply coming in, pulling out, interest rate goes down. However, the second order risks you're referring to haven't been tested yet. So we're not touching any of that because I can't measure it. There's a long way of saying I cannot measure the second order risks of money locked in liquidity pools, et cetera. And I'm not making a judgment of them.
I'm the same. I'm not comfortable with it because I can't get my head around what the risk actually is.
Yeah, I'm very comfortable with a trading system that has a 3% trail stop on it. I know what I can lose and how many times it can get chopped. I have no idea if it can be just hacked away or because we've seen some of the events where pools get destroyed. I won't pick on the one that happened last year, but that was pretty destructive.
Yeah.
And then I'm kind of getting my patience worn thin on ETH 2.0 at this point. Vitalik, if you're listening, they need
for what reason?
Well, I think we've gotten to the point where there's so much layer twos on top of this that we need to see the prices come down on gas fees and transaction costs. There's only so much these young-ish developers are going to take, and only so much the public is going to trade.
And do you think ETH 2.0 solves that?
I believe that it solves part of it. I'm not. My acumen is not skilled enough to declare to say that it does, but my understanding is that it would help.
And when do you think it comes out?
I thought it should already be out. So I hope by November is what I'm hearing. But
that sounds quite late, right?
Yeah, but it'll probably happen, in a corrective period where it's going to need to happen. And hopefully that's what helps provide a floor to it.
Yeah. The other one you mentioned, this is at a tangent now. I've been hearing from a few people I won't mention, Definity. What is this? Because I read it and I can't get my head around this, but this sounds massive. The money in it, the value that's in it. We haven't talked about it as far as I know. I'm sure somebody in some interview has. What the fuck is this? What's coming?
I mean, I don't want to do a commercial for them.
No.
But how it reads, I actually reviewed.
But everybody I respect is like, oh my God, this is massive.
And their smart contract code is called Makoto or something cool. The name's really unique, and we actually reviewed the code. I mean, it's as badass as it comes.
And what is it? It's like Internet 2.0 is what is being built.
Internet 20.0. It's the Amazon and Google killer is what it is. And I might be advertising for them more robustly than they would. But if what it's purporting to do is real, and it seems like you can audit this stuff. This isn't rocket science. They're going to add a lot of value to all the interface.
And it's backed by like Andreessen Horowitz, huge amounts of capital. It's already worth like, I don't know, 40 billion or something stupid.
Mid 40s, I think, yeah. But
there's not even a token that trades, is there?
No.
So it's already valued without any business at $40 billion.
Mm-hmm. And
nobody in the non-crypto geek world knows anything about this.
It's OGs versus new Gs. I mean, some folks that have been in it for since 2011 are hypercritical of this project, and then other folks that are more maybe my vintage 5 years or so are like enamored by it. But either way, it's going to get its chance to compete. So
but it's not cryptocurrency; it's like a whole protocol.
Yeah, the smart contract code is close enough for rock and roll, but it's not a native crypto, no. But that doesn't mean they can't do one.
I have no idea. It's like this mystery thing coming for me, but I'm sure a lot of people watching this will go, of course, we know all about it. I'm just starting to figure it out.
Well, and I don't know how you would know all about it, because it's only by the folks who invested in it early, who I've spoken to, and then what they make available for you to review. Right. Of course, it reads fantastic, but I don't know. It does. It seems to me that it's not going to do a flub like some of the other non-crypto but crypto companies that have put out projects and stuff that have not really been accepted by the community, et cetera. It seems like they would be, but if they can execute on their use case, that's going to add a lot of value.
Fascinating. So, what are you most excited about going forwards now? So your opportunity set, what you're doing, obviously the big opportunity is as the space grows, brings new investors, you've built, huge institutional grade business there, but it's still relatively small, which is, a fascinating part of all of this. What are you most excited about going forwards?
Every day I'm equally excited. I don't have an end state. I think my team, is going to try and do this till we're dead. And,
never know, crypto might kill you first.
Right, which may not be more than a decade. I definitely did not have lines before getting into crypto. That is for sure. But I think from our perspective, what we're really looking to do is to take investors maybe through a few cycles, show them what we're made of as managers, not just within the strategy, but as discussing this openly and honestly with clients, making very client centric. This isn't a fund that you can access everybody. We're very transparent. We're pretty kind human beings. So we do value the experience and want to make sure that we're adding value to someone's portfolio holdings. For example, if someone hasn't invested in Ether bit, they shouldn't come in to what we're doing until they've done that.
And why the hell haven't you tokenized this? Because that is coming.
Well,
let's get through all the bloody paperwork, everything.
Yeah, I think I do what my lawyers tell me to do.
Yeah, but you're US. But let's assume we're a global entity. Why is this stuff?
We have the offshore. We're about half our investors come through the Cayman entity,
okay.
And I would not mind residing next door to you down in the Caymans. We're Salt Life families down here in Florida, and that's just a hour and a half flight. I'm not a yay or nay on that. I think the one aspect of our team is certainly heavy decentralization. We'd like to democratize access to a team like ours, but at what level is it responsible? And I would argue, maybe at this current juncture, we need to go a few more innings before that's a reasonable way to do it. I think where that's applicable is when you're looking at, like, I'll pick on Schwab and Fidelity and maybe Interactive, where they have hedge funds on the platform. A token might be a reasonable way to access our fund versus the 40-page or 100-page
Yeah,
PDF.
but is there a way of creating a token that's only for accredited investors, or you can only access the token if you have XYZ balance on FTX or Binance or whoever it is, right? I'm just thinking, I just have a feeling that this whole business has still got another round of disruption to go.
Oh, for sure.
And all of these stupid fund offering docs and all of this way, it's all going to go.
It's archaic still. So I'm not a no to that. I'm a yes, but I don't know that we're going to be the first mover there. Maybe we end up being the first mover. But we want to do it without disrupting what we've built per se, and without our existing investors having any risk exposure to that process. Would it be amazing to help develop that and be a part of it? Sure, we have looked into it a few times, and I think a few of our friends like us are looking at it to at least have the outline of the processes documented. So when it's time and when it's easier to execute, not as costly, we'll be able to do it. I think what maybe harmed our team is we were old enough in the space to be part of that ICO craze and watch others do stuff like that. That was a big turnoff. And no offense to the successful ICO projects, but I don't like, or nor do I raise, or put my own assets in tokens that are raising for something that doesn't exist yet. That's just an investment mantra that I've had since I was younger. So I'd want to be a little more mature in our own business to do that, and then also perhaps have a benchmark and somebody who takes this first.
And some regulatory clarity. That's the whole problem, is the bloody regulators so far behind.
Yeah, and we've got armies of lawyers and plenty of friends at all the regulators and have had for decades, as you know. We just are not going to be the ones that bring all of their attention to us just because of the token aspect of it. Like, nothing's not going to be above board, but it's just unnecessary business risk right now.
Yeah.
No, we're just fearful of what, it's always the unknown unknowns, right? The known unknowns we got, the unknown unknowns, we can't solve for all of them, right?
Chris, listen, fascinating. There's a lot in that for people to understand, because it's a whole new world, but it's kind of the world that we all knew, but it's kind of changed a lot in the complexity. But look, amazing, really super interesting.
Well, thank you. More good on you for more exposure to the complexity. Every conversation I have, very few people are aware of how dynamic, how diversified, how many sectors there are, and what it takes to analyze this stuff. It's inspiring to us, but it is overwhelming every day. There's not enough time.
And you're only one section of what's going on to the overall thing, right? Yeah. That's what I can't get my head around. I feel kind of queasy half the time because I'm like, I just physically cannot keep up with this. I laughed, I was on Twitter the other day laughing about Sam Bankman-Fried having the idea of launching an exchange in November 2019, building a world-class platform 4 months later, launching it, becoming the third largest platform by volume a year later.
Incredible. It's fascinating, and good on him for doing that. The speed with which these iterations are occurring is absolutely incredible. And it actually makes me hyper bullish for humanity. We believe very, very succinctly on our team and very passionately, this is man's last ability to protect him from himself. Very, very black and white, right? And the way that the iterations of these sectors are developing, it's absolutely incredible. And I think it brings new revenue streams and monetization opportunities, top down, but also bottom up. And bottom up is really what the whole world's been missing for a few decades, as you know.
Super exciting. Well, mate, thank you very much.
Cheers.
And I look forward to catching up with you. I'm sure we'll catch up on Real Vision soon, and we'll catch up otherwise as ever.
Well, keep creating the best content on planet Earth, Raoul.
We will do our best, my friend. Thank you.
Appreciate it, buddy.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.